If you were looking to purchase a home in the Los Angeles area with little money down and not the best credit, then you should absolutely consider an FHA loan. FHA just released their guidelines for 2024, and we're going to talk about the requirements for FHA, the new loan limits, what private mortgage insurance is, and what a debt to income ratio is, and what type of properties FHA lends on. Now, before I do that, just to explain what FHA is, it stands for Federal Housing Administration, which is a government-sponsored program that offers insurance to FHA-approved lenders to give mortgages to homeowners or potential buyers who want to put little money down. And that is probably one of the best parts about FHA financing is that the down payment requirement is only 3.5%. If you have a credit score of over 580, you can put 3.5% down on a property. Now, if you have a credit score between 500 and 580, then you will need to put 10% down, and they're going to look through all of your records with a fine-tooth comb. But if you do have a 580 or more, then you will be able to qualify for an FHA financing with 3.5% down. So for example, if you are buying a $900,000 home in the Los Angeles area and you want to use an FHA financing, 3.5% of that is $31,500. There is a myth that you need to put 20% down on a property in order to get financing, but that is not the case, and FHA financing will allow you to put only 3.5% down. FHA loan limits depend on where you live. I put the link in the description down below and you can see what the FHA loan limit is in your county. Now, because we're in Los Angeles, this is considered a high value market. It's going to be substantially higher than other parts of the country. This year, the loan limit was $1,089,000. Next year, it's going up to $1,149,625. So that is a substantial increase, and it will allow more buyers to get into those properties that are high ticket value for less money down. In order to qualify for an FHA loan, your income and your debt have to be below a certain percentage. This is called a debt to income ratio, or DTI. Now, for example, let's say you make $144,000 a year. Divided by 12, your monthly income is $12,000 a month. Now, let's say your housing expenses, this includes principal, interest, taxes, and insurance, are $4,000 a month. If you divide 4,000 by 12,000, you're going to get 33%. You are in the clear for FHA financing. The upfront percentage to qualify for your debt to income is 47% with FHA financing. But it doesn't end there. You also have to include your back end ratios. So this will include all of your revolving debt, like credit cards, student loans, car payments, any kind of medical payment system that you're on. All of those get wrapped up into your total DTI. Let's say, for example, all those add up to about $1,500. So you add $1,500 to your housing. That's a total of $5,500 for your total debt that you have on a monthly basis. Divide that by 12,000 and you get a DTI of 45%. You're well underneath the limit of 57%, which is the maximum that you can have for an FHA financing. That is a rough way to estimate your debt to income ratio. But again, throughout this entire video, what I'm talking about, you can do with a mortgage broker. That is the best and easiest way to see what you qualify for, is to actually talk to a mortgage broker. There's a couple things that you're going to need in order to get fully pre-approved with a mortgage broker. And I would highly recommend doing that even if you're looking 6 months, a year down the road, because they can see what is on your credit report and they can give you a game plan of what you need to do in order to be able to qualify for a mortgage down the road. Like I said before, buying a home in Los Angeles is so tough because it is so expensive. So you're going to need to plan every step of the process. If you want to plan a year out, do it now so you're ready to go in a year. One of the best ways to do that is actually to talk to a mortgage broker. If you have any questions or if you need a referral for a good mortgage broker, just click the link in my description and I'll connect you with a really good mortgage broker. And you'll get a free mortgage guide to kind of walk you through the steps of the process as well. And in order to get fully pre-qualified, here's some documentation that you're going to need. You're going to need your last 2 years of your W-2s. If you're a business owner, you're going to need your last 2 years of your tax returns. You're going to need your last 2 months of paycheck stubs, last 2 months of bank statements, your driver's license, and your social security number. If you have a brokerage account with stocks and bonds or retirement accounts, I would collect that as well so you can provide that to your lender. A lender is going to go through all of your documentation and they're going to tell you how much you can qualify for a mortgage. Now remember, when you are getting pre-qualified for a mortgage, make sure that you are comfortable with the monthly payment. You don't want to be in a situation where you are freaking out every single month because of the mortgage payment. So maybe scale it back a little bit to a place that you are comfortable. Now let's talk about a couple things that are not great about FHA financing. For example, if you get a loan and you do not put more than 20% down, you're going to have to pay on a monthly basis private mortgage insurance. Private mortgage insurance is basically for the lender because if you default on your property because you're not putting 20% down, that private mortgage insurance will protect the lender in case you default. One bad part about having FHA financing is that your private mortgage insurance stays with the life of the loan as long as you keep it. It doesn't fall off like conventional loans at 80% loan to value. So you will have mortgage insurance the entire time that you have an FHA financing. But you are always welcome to refinance and get a different type of loan product that might not have mortgage insurance. But with FHA, it stays there with the life of the loan. Now, the way to calculate mortgage insurance is a little complicated, but I'm going to show you an example right now. So let's say you're purchasing a property for $850,000. Your down payment is going to be 3.5%, which is total of $29,750. Now, in order to get your base loan amount, you're going to subtract $29,750 from $850, and you're going to get $820,250. Now, before we can actually give you a calculation for the mortgage insurance, I have to talk about one other thing. There is a thing called an upfront mortgage insurance premium that everyone who buys an FHA, regardless of how much you put down, is going to have. This private mortgage insurance is 1.75%. Now, typically, most buyers will finance this 1.75%, which will adjust your base loan amount. So if you take your previous base loan amount of $820,250, multiply it times 1.75%, you're going to get a total new loan base amount of $834,604. Now, once you have your new base loan amount, you're going to multiply that by 0.55%. So that will give you your annual mortgage insurance premium amount, which is $45.90. What you need to do is now divide that by 12, and that will give you your monthly mortgage insurance of $383. Private mortgage insurance can add a significant amount to your monthly payment, but having a low down payment versus a high monthly payment might be worth it for you. It just depends on your situation. Now let's talk about what type of properties that you can purchase with FHA financing. You can actually get single family homes, condos, and townhouse, but the caveat with condos and townhomes is that those complexes have to be FHA approved. Not every condo and townhome complex goes through the process to get FHA financing. So in some cases, you might have to go through that FHA approval process while you're in escrow, which can take a long time, which could delay closing, which could be an issue for financing down the road. But if you get a condo complex that is already FHA approved, then you can go through the entire loan process just like normal. You can also use an FHA loan to purchase a multifamily home and do a house hack. So you live in one of the units. Let's say it's a duplex, a triplex, or a fourplex. You are allowed to use FHA financing with a multifamily home. However, there are some requirements, and specifically the self-sufficiency requirement, which means that if all of those units are rented out, they cover themselves. If the rents of your multifamily don't cover your entire mortgage payment, then you would not be able to use FHA financing. But if that is something you're interested in, there is a new program that allows conventional financing for 5% down on multi-units. So if you have any questions about that, just reach out to the link down below, or you can call me directly at 213-268-6832. One of the other specifics about FHA financing, about the actual property condition, you cannot have peeling paint. You can't have a missing furnace, and you can't close on a property bare floor, meaning like there's no flooring in the property. You have to have some kind of flooring in the property in order to qualify for FHA financing. You have to have most of your appliances there, like a stove. So there are some requirements for the property specifically that have to be met in order for you to get FHA financing. That's why you'll see a lot of times properties that are in disrepair or need a lot of work, they won't qualify for FHA financing, so it's not offered in the multiple listing service. So if you are looking to purchase a home in 2024 and you want some help, just click on the link down below. I have a free buyer's guide that will walk you through every step of the process. I'm more than happy to help you with any questions that you might have. My name is Felipe Crook with EXP Realty. I've been a realtor for over 20 years, going on 21 now. And if you have any questions, please feel free to give me a call at 213-268-6832. You can also text me at that number. Again, my name is Felipe Crook, investing in your dreams.